I think around here we know basically there's a decline, if you like, in the faith of the dollar. As I keep on trying to tell people, it's not gold going up, it's the dollar going down. But I mean, I think that's the stark reality. 27% increase or 26, whatever we end up with, whereas US money supplies increased by 3%. And this is telling me, anyway, that faith in the currency is really beginning to decline now. And I think that's probably the most notable development that we've seen in 2024.
Mark my words, the great taking is very real. And a lot of people, a huge amount of people, are going to be left with nothing.
The expansion of Western sanctions, often termed the weaponization of the dollar, has driven many emerging market economies to shift their foreign reserves toward gold. As a tangible and stable asset, gold is seen as a protective measure against the potential risks of confiscation or instability tied to fiat currencies. Over the past 15 years, nations such as Brazil, Russia, India, China, and South Africa have accumulated nearly 5,000 tons of gold for their official reserves. China and Russia have been the most prominent players in this effort, each adding more than 1,500 tons. Officially, China reports holding around 2,300 tons of gold. However, financial analyst Bill Holter suggests the actual figure could be closer to 5,000 tons. He explains that China intentionally underreports its gold reserves to avoid market disturbances that could drive up prices and limit its ability to acquire more gold at favorable rates. A significant portion of China's gold purchases is made covertly, a strategy also shared by other nations like Saudi Arabia. These secretive acquisitions have led to discrepancies in official reports from organizations like the IMF and the World Gold Council. Bill Holter estimates that approximately 80% of the gap between reported and actual global central bank gold purchases is due to secret Chinese acquisitions. Other nations, including Russia and Saudi Arabia, follow similar paths, discreetly using sovereign wealth funds and alternative channels to amass tangible assets. This practice aligns with the growing de-dollarization trend as countries seek to reduce their dependence on the US dollar. These moves indicate preparations for potential shifts in the global financial system, with increasing speculation about a possible revaluation of gold or the introduction of a new monetary standard. We will present clips from Bill's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates.
Absolutely, you've got China trying to buy directly from miners. And that's a huge deal because that means there's going to be less metal that'll make it to refiners and thus less metal available for LBMA and for COMEX. One other thing is that, very interesting, back in, I think it was October, Russia announced that they were going to be purchasing other commodities, and the first one they named was silver. And I mean, the supply and demand is on a knife's edge, so you get, additional demand is going to blow up the supply. From a short-term, technical standpoint, we're oversold again. I mean, we've seen multiple times this past year where the metals bottomed. I posted, and I think, Andy, you posted my charts also showing the bottom hooks. And I think what that illustrates is exactly what Andy was talking about, central banks stepping up and creating demand for gold. Not so much silver directly, but silver's going to move with gold. So I think that is definitely significant. And I really don't think it's important. If you're wanting to know, should I buy at 29? Should I buy at 27.75 or whatever? Who knows? And when all is said and done, it's not going to matter. The whole idea is that you're getting your capital out of the system and into something that cannot bankrupt. Because when this whole thing goes down, mark my words, the great taking is very real. And a lot of people, a huge amount of people, are going to be left with nothing. I mean, I've seen it all going back to, I was a broker during the 87 crash. So, I watched the reflations, I watched the credit bubbles, I watched the credit bubbles blow up. And we are in a global credit bubble not ever seen in the history of man. And I would just tell you that all credit bubbles blow up throughout history. I mean, you can go back hundreds of years, and every credit bubble ever has blown up. And that's where we're headed. I do want to mention, as long as we're talking about the stock market, you mentioned Warren Buffett. Warren Buffett, I mean, I can remember back in 1998, 99, people were saying, Warren Buffett's washed up because he wasn't buying the dot-coms. He was raising cash. He had a huge amount of cash going into 2000, 2001. And of course, the market cracked. Same thing happened again in 2007, 2008. He was raising cash, and he now, I think the number's 145 billion in cash is what he's sitting on. And that is the largest amount of cash outright, and the largest amount as a percentage that Berkshire has ever held. So the reasoning behind him raising cash, and I mean, he says this himself, is that he can't find anything of value or of good value to purchase. So cash is a better place to sit. Now, I do believe that when this does go down, Warren Buffett is going to find out that he's sitting on the wrong type of cash, because ultimately gold and silver, they are real monies. And historically, you went to cash for safety. And if you've got a credit event happening, how safe are some of these sovereign debt securities going to be? I think we're going to find out that, not everything's AAA rated, not everything's safe. And we're going to find a bunch of sovereigns that get discounted and downgraded, maybe even completely collapse. I also believe that 2025 is going to be the year where you're going to see a differential of market rates, not necessarily interest rates that the central banks are using, but how those sovereign treasury bonds are valued. And I think 2025 is going to be the year where there is discernment between credit A, credit B, credit C, based on risk premia, which does not exist. I mean, if there was risk premia that existed, Japan, you would have interest rates at what? 15, 20, 30%. I mean, they're 300% debt to GDP. You'd see the US with higher rates than what we have. So I think this will be the year where sovereign treasuries are looked at based on their metrics, as opposed to they're just another sovereign. They're just another sovereign treasury, and everything's fine. So I think that's something that's going to come up. And I also think that because the entire system is a Ponzi scheme, we're really looking at a global debt trap from the standpoint of we've reached debt saturation, and any Ponzi scheme cannot continue unless there's new money that comes in. And the way new money is created is largely by debt. I mean, it's no longer printed like it was during Weimar Germany. And the fact that we are at levels now where, I mean, looking at the US, we're paying over $1 trillion in interest. This year, it'll probably be $1.5 trillion. And within 2 or 3 years, we'll be paying over $2 trillion. And that's if interest rates stay where they are. But to be clear, I do believe interest rates are going to rise from here. So that interest expense is going to come into focus faster and faster. And that blows up the system. It blows up the Ponzi scheme if new money doesn't get borrowed, because that's the lifeblood to both the financial markets and the real economy.
Alasdair Macleod issues a stark warning about the global financial system, which he believes is on the verge of collapse. As the head of research for gold money and a leading expert on precious metals, Macleod highlights the monstrous credit bubble that has been growing for decades, driven by reckless monetary policies. He compares the current situation to the South Sea bubble and tulip mania, but stresses that this bubble is twice as large. When it bursts, he asserts, central banks will be powerless to prevent the consequences, and the global economy will face a severe crisis. Macleod points to rising interest rates as a key factor contributing to the impending collapse. He explains that interest rates are rising for two main reasons: governments being trapped in debt. He warns that if the yield on U.S. Treasury notes rises above 4.75%, it could set off a chain reaction, causing crashes in both equities and cryptocurrencies. For Macleod, this is a critical moment in which the rising bond yields will destabilize the entire credit bubble, leading to a collapse in the stock market and crypto assets. He stresses that in such a crisis, gold will be the essential refuge for investors. As the value of the dollar declines, gold will rise, serving as a hedge against the collapsing financial system.
Basically, the credit bubble has continued to inflate, if you like, and we're now on the verge of seeing interest rates going into new highs. Not interest rates, sorry, bond yields. Interest rates will have to follow, I suppose. And that'll pop the bubble. So we've seen if you like, I think the best of markets, and I'm referring to equity markets, Bitcoin, all that sort of stuff, the stuff which really needs credit to inflate its values. I think those days are now dying, and that, I think, was the big feature of 2024. I think the other thing I would say is that as far as the bullion banks are concerned, gold rising, 26, 27% on the year shouldn't have happened when money supply increased only 3%. So what's going on? I think around here we know basically there's a decline, if you like, in the faith of the dollar. As I keep on trying to tell people, it's not gold going up, it's the dollar going down. But I mean, I think that's the stark reality. 27% increase or 26, whatever we end up with, whereas US money supplies increased by 3%. And this is telling me, anyway, that faith in the currency is really beginning to decline now. And I think that's probably the most notable development that we've seen in 2024. We can sort of discuss details about how, for example, the stands for delivery on COMEX are just going on all the time. What does it mean? And all this sort of stuff. But the reality is that increasing numbers of central banks do realize that the risk in their reserves is in the fiat currencies. And so, in effect, they have been selling fiat currencies to buy real money, real legal money, which, the Romans first classified as legal money in 448 BC with the 12 tables. Admittedly, gold wasn't in it then. It was sort of, copper, brass type thing, and gold came later. But, and if you look at Diocletian's edicts, which I think were 305 AD, so 800 years after the first Roman laws came out, and you look at the prices, where the prices actually today expressed in gold are really quite similar. And that's the whole point about, in money. The growth of above ground stocks has more or less kept pace with global population, averaging around about sort of 1.5%, 2% per annum. So it's not surprising that, there is a balance, if you like, in the whole thing, which means that the purchasing power of gold remains constant. All the other fiat crap, it just basically loses it and loses it and loses it. And it loses it. Normally it's an interesting one because the monetarists, they do understand the dilution, if you like, of purchasing power of a currency, which they call monetary inflation. That's one aspect of it. But the other aspect, which they haven't really grasped, is it's that faith which is now being eroded. This is why I mentioned 27% increase in the price of gold, or put another way, the dollar in gold has lost a quarter of its value in the last year, whereas money supplies only increased 3%. You know, what's that telling us? It's telling us that the dollar is actually on a very slippery slope. But the thing that's, sort of surprising in a way to some people is that the dollar is the strongest currency. I mean, you look at the trade weighted, look at the chart of it. It's got a golden cross under it. Dollar's going up. Yeah, of course it's going up because all the other rubbish is even worse. So, but measured in gold, I mean, here I am in the UK and we've got a new socialist government. Nobody here has really bought gold, but it's the one thing to have because sterling's going to go down against the dollar's going to go down against gold, interest rates, or rather bond yields, are going to rise, which is going to destroy capital markets completely. There's only one thing you can have when credit is collapsing, which is effectively what's happening, and that is gold. And I think that's really the outlook for 2025. I'm probably jumping the ground. Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high, and it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So, leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money. So the point is that you have the entire system trying to de-risk itself, not by, in aggregate, reducing its overall level of credit, but by, if you like, taking funds away from the private sector and applying them to government, and specifically applying them to government through the T-bill market rather than longer-term maturities. That's the way in which the banking system de-risks itself. The problem with that, obviously, is that it kills the private sector. And, Bill made the point earlier about, the falsity of the GDP numbers, because so much of it is actually the expansion of government credit, which is it's inflationary. It's not it's not credit aimed at production in any sense. Production in the sense that the private sector is producing something that people actually want, that they will actually demand. No, this is credit which is produced by a government which says, you will have this, you will have that. Now, this is inflationary. So this is the background against which the banking system operates. Now, there are ways in which the level of outstanding bank credit can be reduced. The first is businesses go bust. And I think we're going to see quite a lot of that in 2025. And the second is that banks go bust. If you look at what happened in the 1930s, when money supply contracted by something like 40%, it weren't because the credit was sort of, if you like, being, contracted by the banks. No, it was because banks were going bust and businesses were going bust. When an obligation is no longer available, the credit on the other side disappears. It's completely worthless. So the point about this is that in 2025, as bond yields rise, and particularly the 10-year, we'll see that go through 5%, I think probably in the first quarter of this coming year. If that happens, and I think it will, then you'll find that banks and businesses will be getting into trouble. So what does the Fed do? It will move heaven and earth, Fed and Treasury, move heaven and earth to ensure that no bank defaults on its obligations to its depositors. So what we're looking at, I think, is a bailout of the entire system.
Gold is expected to remain a key investment in 2025, with analysts maintaining an optimistic outlook while recognizing potential challenges. Goldman Sachs has set a target of $3,000 per ounce, driven by expectations of continued strong demand from central banks and gradual increases in ETF holdings as the Federal Reserve continues its easing cycle. However, several factors could influence gold's price movement. The prospect of a second Trump presidency introduces new variables, particularly regarding potential changes to global trade policies and economic relationships. The Federal Reserve's approach to interest rates will also play a significant role, with the recent indication of fewer rate cuts than expected for 2025 possibly moderating gold's upward momentum. These factors will shape gold's trajectory in the coming year. How do you think gold will perform in 2025 with the uncertainty surrounding global trade and economic policies? Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.